Welcome to this evening's live online webinar. My name is Darren Wagner. I'm the founder of Morpheus Trading Group, which I started nearly 10 years ago. I'm also one of the traders of our Morpheus Capital Hedge Fund, and I'm also the author of several books, the most recent being Trading ETFs, which was published a few years ago, and actually have another book coming out very soon as well. So welcome everyone. Those of you who have been following us for a while, you probably know we conduct these webinars nearly every week, and the topics are typically different every week. One of the most common topics we cover is we do a technical analysis of the broad market, and then we look at specific individual stock setups that we like for potential buy entry or selling short. That's one of the most common webinars, and we always have a huge attendance when we do that. Tonight, we actually are going to be covering a slightly different topic, something that's different. We're going to be talking about trading on technical analysis versus trading news. And when I put up the poll earlier, all of you actually that answered the poll said that you occasionally trade on news. And I think everybody does, and that's okay. But tonight, we're going to be talking about some of the dangers of this and things you need to be aware of, and why we believe in technical analysis, and why we trade technical analysis versus paying attention to news. Now, you may be wondering, okay, well, how are you qualified to talk about this? Well, I like to say that we put our money where our mouth is. If you go to the Morpheus Trading Group website and click on performance here, you can see our average annualized return is about 15% in both of our Wagner Daily and Stock Sheet newsletters. Now, 15% may not sound like a lot if you're a new trader. Maybe you have high expectations of making 100% a year. Yeah, okay, maybe that's going to happen sometimes, but you're also going to have big losing years. We strive for consistency, and more importantly, this goes back, our track record goes back to 2002. Since then, we're one of the few newsletter businesses, such as ours, that actually tracks and reports every trade through good quarters and bad quarters. So in 2008, when the market got killed and was down 40% or so, we actually made money. And in fact, if you look at this graph, this kind of sums it all up. The Stock Sheet, for example, which is our swing trading newsletter for stocks, has a cumulative annualized return, not including compounding, of 109.7% since it started in 2004. The S&P 500, this red line, during that same period is up 2.8%. So obviously it's a pretty big difference there. So we do feel we're qualified to talk about this topic this evening because we have every trade that we've ever made is tracked. The other thing is, in addition to actually having a proven track record, we have a very talented team. Rick Petticelli and Ed Balog, those of you who are subscribers, you probably know their names. And Rick actually writes the stock sheet every day, and Ed does a lot of the Wagner Daily newsletter and the ETF picks. And tonight's presentation is actually going to be conducted by Ed Balog. And Ed comes to us with very high marks on paper. He's actually a graduate of Notre Dame University. He's got an MBA in finance from Notre Dame University. But more importantly than that piece of paper is he's a stellar trader. He does a fantastic job. He's one of the reasons that our track record is so good. And he's also a trader of our hedge fund as well. So I'm going to be turning things over to Ed, who's going to be conducting this evening's webinar. When Ed is done, I'm going to have some closing comments, and then we'll open it up for any questions and answers. Tonight's webinar will probably be a little shorter than usual, maybe 20 to 30 minutes or so. Okay, so Ed, if you're ready, I'm going to go ahead and turn things over to you here.
You know, as Darren mentioned, we avoid trading news because you know it changes with the wind, and what's interesting. I have an interesting little tidbit here. This comes from Robert Prechter at EWWY International, and it's very interesting. On February the 18th, 2010, the Fed made a surprise move. They raised rates, the discount rate, and of course the stock market plummeted in the morning. And these were some of the headlines. Wall Street opens weaker after Fed move. Investors are wary of Fed move. Stocks opens lower.
Order filled.
So on and so on. Then at 11 o'clock, the market reversed. and we closed higher on the day. And by the afternoon, all the major news outlets were saying U.S. stocks bounced back, Fed move viewed as positive. Stocks up, stocks higher after Fed move, blah blah. So within a single day, you get a total reversal in the market and a total 180 in the opinion of the media outlets. News is just after the fact. It doesn't drive the markets. It's after the fact. The information is already there. Just at some point in time, the markets decide to react one way or the other based on the mood within the market, and you can't avoid that. And this is why we stick to technical analysis. Now, let me give you a couple recent examples here. On November the 8th, okay, November the 8th, which is right here, this day, I'll circle it. That's November the 8th. And on that day, Barclays came out in Europe and said that it's over for Italy. Italy will, under no circumstance, will Italy be able to pay its debt back. There's no chance that they're going to basically survive as a sovereign nation under the euro. And they were very abrupt about it and very, very emphatic about it. And what happens on that day? The market rallies. We basically open at the lows of the day and close virtually at the highs of the day. Now, we had a distribution day the next day, but look at what we've been doing since then. The market's chopping around in a sideways action, and the price action is getting tighter and tighter. We're forming a bullish pennant-like formation. So for the moment, based on technical analysis, it would be foolhardy to try to short this market. Now, does that mean that the market's not shortable at some point, that we couldn't break down here? Well, of course you could break down here, but the bigger point is that you have to wait for the confirmation. Trying to guess this stuff, you're just going to get chopped to bits and nothing will happen. So since this day, first we had a rally that day. We really haven't gone very far. We're just sitting in a tight trading range. Tomorrow, if we reverse back up and break to new highs, what difference did it make? What Barclays had to say on the 8th of November? Another good example. Let's take a look at Apple. Sadly, Steve Jobs dies on this day, right here. Preceding that, the previous day, what occurs with Apple stock? We get a massive reversal candle. So on this day, the 4th of October, we have a massive reversal candle where the market came down, the Apple came down, touched its 200 period moving average in orange, and then rallied to close near session highs. I mean, there's a clear technical indicator, a clear potential for reversal, and it would be very dangerous to get short this stock at this point. And of course, what happens the next day? Yes, it was a very whipsaw day, but when it was all said and done, on the 5th, when he died, we closed near session highs and then proceeded over the next 8, 9, 10 days to rip and actually set a new all-time high, a new all-time closing high. So, just another example of how news can really get you in trouble. I suppose you can trade off of whipsaw reactions if you're day trading. We're mainly swing traders, but to invest or to swing trade off of news, it can be very counterproductive. Here's a list of stocks that are the most upgraded stocks in the past couple of months. Okay, ALU, Alcatel Lucent, everyone in the world saying what a great value this is. And I remember the first upgrade occurred right here. It was upgraded, it rallied for about a day or two, and look what's happened to ALU since then. It's just been riding along its 20 period moving average, in brown here, this brownish colored line. It's lost 60% of its value since, with all these upgrades occurring. Everyone's saying buy it now. This is the greatest stock ever, and yet you'd be down 60% over the past several months. Another one, another underperformer that's being upgraded left and right is RIG. You couldn't find a much more negative looking chart. This thing's been in a severe downtrend now since basically early 2011. Yet it's one of the top 10 most upgraded stocks recently. BLK. The list just goes on and on when you see stocks that are just massively underperforming. Baker Hughes and Broadcom's another one. So you look at you want to talk about stocks that are just chopping around or looking to set new lows. These would be it, and that's why we rely on technical analysis and a very stringent approach to deciding which stocks or which ETFs to be in. If we look at what we try to do is separate things out based on technical analysis and say, okay, where would I want to be if the market's going to break out versus where would I want to be if the market were to break down? So where do you have relative strength and relative weakness, and where are the potential opportunities in the market? So for instance, on the ETF side of things, and I'm going to show ETFs mainly because they're broader market indicators for various sectors. You can get an idea what's going on with most stocks in the sector if you're looking at an ETF. So recently we've been looking a lot, or we've been following XRT, retail, and this is one of the few ETFs that's been holding on to it. It's above all of its major moving average. The 200 period's been upsloping for quite some time now, several months. We've been riding the 20 period moving average. Obviously, everything struggled today into the close, and we did have a distribution day. But XRT is one of the better performers out there in the ETF world and retail stocks in general. Another has been PPH. These are not not the stocks that you would want to short in if the market turns here and we start getting lower. We don't want to short things that are above major moving averages. We want to short things that are showing relative weakness, and this is where technical analysis plays a big role. So for instance, if we look at EWP, which is Spain, I mean, we're below every major moving average known to man. And look what happened today when we got a negative situation in the market. Now we broke below this 4-day low, and it appears as if we're going to head lower. Another EWWY, Japan. I mean, we're looking at an ETF here. We've been tracking this one for a while. That's basically breaking a shelf of support that dates back a couple of years, a year and a half, 2 years. And of course, the market turned negative today, and look what happened. We lost this key support level, and we closed near session lows as volume increased. Notice the spike in volume. We had higher day over day volume. Now, the point being that we could get caught up in all kinds of news, and try to trade off of that, or you can look and see what's the chart doing. And I suppose another way of looking at it is when you look at things like EWWY and EWP. I mean, Italy is in as bad a shape, if not worse, than Spain. And it is pretty much likely that they're in trouble. I mean, France is in major trouble because they're so tied so heavily into India. They have hundreds of billions in dollars of loans sitting out with India, and there's a big line in the sand that's going to have to be drawn. That's a systemic issue. I always say that there's news and then there's systemic issues. The systemic issue is that Italy can't pay its bills. Greece can't pay its bills. Spain can't pay their bills. And particularly with Italy, if Italy can't pay its bills, that it's pretty much riding a fate of doom for France. However, what's the market been doing? This is nothing new. Everyone's known this for months now. The circumstances haven't changed. It's all the same stuff. It's been out there for months. Yet the market's been rallying recently in the face of all this. And frankly, being how negative that news is, why isn't EWWY? Why aren't we setting new lows? I mean, we're well off the lows here, which certainly several months ago, when this wasn't even being talked about, we set much lower lows than where we're at now. So, as I mentioned, what we do is we follow technical indicators. We follow what's a stock doing? Is it in an uptrend? Is it in a downtrend? Are we above the key moving averages, or are we below the key moving averages? Is there distribution going on in the market? For instance, right now, after a day like today, the common wisdom would be, well, maybe it's, watch out below, the whole market's going to blow up. Well, maybe it does, maybe, but however, we don't get into all the opinion type stuff on that. We just look at it and say, all right, we have certain rules. Well, distribution days. We're looking for, if we get 5 or more than 5 distribution days in a 20-day period, that's our rule for one of the rules that we use for deciding whether or not we should be long or short in the market. Right now, over a 20-day period, we have 4 distribution days. So there's cause for concern. Certainly, you've got to be aware of it, but it's no reason to just jump ship and say, okay, well, I'm going to get short the market here.
Order filled.
We're sticking to a rules-based system. So by doing this, what's important about that is you don't get into trouble. You're not over trading. We've been trading very little over the past couple of weeks. We made a lot of money a couple of months ago. We were short, heavily short during this move down right here, because our trading rules and the technical analysis we do kept us in the market on the short side during this time period. However, here we've been dipping our toe in the water on the long side, but very carefully. And why is that? Because our technical indicators are telling us, hey, it's we should have a long bias based on the fact of this first thrust reversal we have here, and that we're just pulling back into a support level, and that we haven't established enough reversal days, amongst other things, not just reversal days, but amongst other things, that suggest that we should be looking to get short the market here. But nonetheless, that's the human tendency. When you get really big down days in the market, when you get big distribution days, the first thought is to jump and go to the other side of the trade. But the reality is you have to be a little more patient than that. And if, in particular, if leadership stocks are not falling apart, there's not a lot of reason to assume the market's going to come unglued. There's a saying on Wall Street that the market climbs a wall of worry. And it's true. Markets don't rally on good news. Markets rally when things seem worse. And that's why you have to have what we call a loaded trade. You have to have a situation where most people are either really negative or really positive in order to get movements in the other direction. Because when the trade is loaded and you have individuals that are, like, for instance, very, very bearish, when you get a high percentage of people in the market that are bearish, that's when there's the biggest opportunity on the upside, because it only takes a small percentage move, a very small price move, to elicit a major reaction out of the crowd. And like I said, news is always out there. The information's always out there, and it doesn't change. Nothing's changed. Italy was in this problem 6 months ago. They were in this problem a year ago. They're in the same problem now, but the market's been rallying lately, the U.S. markets, and it's, that's a total disaster. It just doesn't matter. So when a news appears to matter is when the market decides it matters. But the reality is, news is just a reaction, an explanation after the fact. And that's why we rely heavily on technical analysis. and it keeps you out of trouble. That's why we're not very heavy in the market right now. And we've been mainly on the long side recently and not on the short side as this market's been rallying and most recently been chopping around. And the same held true when several months ago, we didn't try to catch the bottom. I mean, you'll get people to say, well, these oscillators are showing this or that's showing that. And, was this the bottom? Well, was this the bottom right here? Was the bottom here? Was the bottom here? Well, eventually it ended up being here, but you don't know that until after it happens. And, you'll get traders that'll try to grab these bottoms just randomly, where our methodology is that you wait for the breakout and then you wait for the pullback and consolidation. And then we look for the stocks that are showing, or the ETFs that are showing the most relative strength to the market. And that's the difference between, successful traders and those who are not. The market is very subtle. It doesn't wave big green flags in front of you saying, oh, okay, buy now. When you're selling is when you should be buying, and when you're buying, you should be selling typically. And that's the way markets work. And news is like a narcotic. It sucks people in. They get caught up in the news rather than just looking at what's happening in front of them on a chart. And the chart is the most pure form of reading human behavior because it doesn't lie. If you're at the low of the day that day, then market wanted to be at the low. The crowd was at the low of the day. If you're at the highs of the day that day, that's where the crowd wanted to be. No individual can manipulate this price movement. It takes a group to do that. And when a group feels that things are overbought or oversold or whatever the situation is, that's the way the market's going to move. It doesn't matter what some headline says in some newspaper, because as we saw earlier from just one example from Robert Prechter, what's driving the market lower in the morning can end up being the thing that drives it higher in the afternoon based on the news outlets. So anyway, that's that wraps up my commentary on all this. We're just, like I said, we're just really big on having a rules-based, fact-based system, and because we're disciplined, even if the market moves against us, we have pre-described stops, and we're going to get out of the trade. You take your loss and you move on. So it's not a question that you always have to be right. It's just that when you're wrong, you have to get out. And when you're right, you have to have risk-reward ratios in the trade that substantiate or justify you being in that trade. So that's really our approach to it. It's a rules-based, math-based, technical analysis-based approach to trading. And by all means, it keeps you out of trouble. That's our philosophy, is keep the powder dry so that when the opportunities come, you have the powder's there to shoot the gun. You can make some money. All right, Darren, that wraps up what I have to say here. And I'm going to turn it back over to you.
Okay, great. Thanks, Ed. I'm going to keep the desktop on you, but I'll take over the microphone here. Great information there, Ed. And there's a couple takeaways here. I mean, when I was a new trader, we've all gone through this phase. I mean, I've been trading now for 13 years actually. And wow, it's been that long already. But yeah, I mean, in the beginning, I used to get caught up in the same thing that's very common for beginners. Well, this company had good earnings news, the stock must go up. Well, it would go down, and vice versa. And it happened time and time again. And Ed showed you some good examples. And one of the reasons for that, by the way, I mean, the reason doesn't matter, but one of the reasons is because typically the news is already built into the price of the stock. The expectation of the news is already built into the price. So therefore, people buy the rumor and sell the news. You've probably heard that before if you've been trading for a while. So it's just so important to filter out the noise. On another level, I mean, this is all the time when I meet people at conferences and seminars that I'm speaking at. People are always like, "Well, do you know about this news or this news or that news?" And quite honestly, I say no, and that's the way I like it, because what I find is that typically news is a big distraction, and it's just kind of noise, especially that circus, some of those circus financial shows. I won't mention any names, but it can really cloud your thinking and throw off, what really matters, and that is price action. What really matters is price and volume, and that's where charts come into play. All charts do is simply show you the price and the volume. If the prices are going up, you want to be long. Prices are going down, you want to be short. I mean, it sounds simple, but really it is if we don't complicate it. So it's a very important point, but yet often overlooked, especially by beginning traders. Um, it's also important to realize that, I mean, I showed you earlier our cumulative performance history and showed you that the stock sheet, for example, is up 109% cumulative since its inception, and the S&P 500 is only up 2% during that time. But that's not because we're always right or we're consistently making money in every trade. No, not at all. I mean, we've had bad quarters and so forth. But what we really do is we have, as Ed mentioned, a rules-based system, and we follow it. And we're very disciplined, and that's why we're consistently profitable and consistently beating the averages. If you're perhaps a new trial subscriber over the past couple of weeks, you may be wondering, well, where's all the trades? We've been mostly flat. We've tested the water, dipped a toe in the water on the long side a little bit, and for the most part, scratched or lost a little bit of money. But we made 10% in our portfolio 2 months ago. So even if you lose 0.5% or 1%, you're still well ahead of everyone else and well ahead of the market. So the key is when there's nothing going on, it's choppy. I mean, you saw the S&P 500 past few weeks has been very choppy. And if you're over trading, unless you're a day trader, which is a different story altogether, but for swing trading, and it's definitely been a very, very difficult market. And when we see that, then we simply stand on the sidelines and wait. And the opportunities will present themselves again sooner or later, and that's where we make our money. But the most profitable traders I know are typically out of the market more than they're in the market. And this is one of those examples why we've been light. It's not important to be in the market every day. That's not your job. Your job is to take advantage of the opportunities when they're there and stand on the sidelines when they're not there. So anyway, I hope you gained some good food for thought this evening. And if you're an experienced trader, you probably already knew a lot of these things we talked about, but maybe it's a good reminder or refresher. And certainly if you're a new trader, then maybe this some of what we talked about was an eye-opener to you. But regardless, either way, we hope you enjoyed it. So we do have some time to open up for questions and answers. If anybody has any questions about what we discussed, or you'd like to look at any charts related to what we discussed, we're more than happy to take a look for you. Just type your question in the chat box if you have any questions. And we've got about 10 minutes for questions. If anybody has any questions, go ahead and fire away. Roger's saying, do personalities affect the decision to pull the plug? Roger, do you mean personalities of the individual trader? Is that what you're referring to? Sure. I mean, absolutely. I mean, some traders are extremely disciplined and rules-based, as we try to be all the time. Of course, we're not perfect. There's gray areas in trading, but most of the time we're extremely disciplined. And then other traders, it's purely discretionary, and they'll pull the plug whenever they get the urge. So it definitely is dependent on personality. And in fact, it's an interesting point you bring up. A lot of people think that to be a successful trader, it's about intelligence, and actually, it's really not. It's more about personality, actually. And if you're the type of person who can have a winning strategy like we have and then follow it consistently. I mean, people who followed our strategy from the beginning, they're blowing away the market. But if you're not able to have the discipline to follow it, then certainly that's gonna matter a lot. I know some very smart people that can't. I like this expression. Can't trade their way out of a paper bag. I mean, basically, intelligence really doesn't have anything to do with it. In fact, sometimes it gets you in trouble because you overanalyze rather than just looking at what's happening. So, yeah, I think personality does play a big part to answer your question. Okay, Mike's asking, do we ever look at weekly charts for entries or exits? Yes, absolutely, Mike. We use daily charts in our examples here, but we're always looking at weekly charts. What we tend to do with weekly charts are great because they eliminate the noise from what's happening out there. I mean, especially when it's choppy. Like Ed, if you could put up a chart of the S&P 500 weekly, we can look at this, but the like the past couple of weeks, if you look at the daily chart, the S&P 500 is bouncing up and down every day, but on a weekly chart, it just looks like nothing more than consolidation. So it eliminates the noise. Now we use the weekly charts to not to determine our specific entries and exits, but really to just get an idea of the big picture and to help make sure that we're seeing things clearly. So we definitely use weekly charts, not so much for entries and exits, but more for confirmation of trend. Thanks for coming this evening. We hope you enjoyed it and learned a few things, or at least had a couple good reminders. And have a great night, everybody.